Alrighty, well, welcome everybody. We're just going to go ahead and get started. For those of you that I haven't met or maybe we forgot, I'm Sam Camarena, manager of the CSU Advancement Academy, which is, of course, the university system's professional development program for all the areas of development, alumni relations, and advancement operations. Today, we're going to explore some key concepts in gift vehicles and plan giving. Thank you all for joining us. This is a very popular topic based on our registration. Before I jump in and introduce our very intelligent speaker, I'm going to just provide a little bit of housekeeping. So I'm going to ask everyone to please update your Zoom display name to make sure it includes your first and your last name, as well as any preferred pronouns. And if you can also add in the short name of your university, that'll be great. That way we get a sense of where everybody's joining us from. And then it's a nice kind of record in case you drop something in the chat. As you can see, the session is being recorded and we're going to be sharing the video to registrants within 2 days. You will also be able to share that recording with colleagues who may not have registered. For any questions that you have for our presenter or for the Chancellor's Office staff, me and Wendy and Melissa, please go ahead and add those to the Q&A feature in Zoom. It's going to be available via the menu towards the bottom. You might have to hit more, so go ahead and look around right now before you have a question, so you could drop it in there. We ask that you use the chat maybe more for reactions to what's being said, or you can do some direct messages to other colleagues on here for some networking, since we saw a little bit of that just before we started. And then you're also welcome. Oh, sorry. There will be times for Q&As related to questions after the presentation, and that's when we're going to go through and clear all the questions that came up through that Q&A feature, and then also provide an opportunity for you all to ask your questions live. So please don't be shy to ask anything. And if you do have an urgent thought or a question to ask during Mary's presentation, you can electronically raise your hand and we'll call on you to get the focus on you. Alrighty. With that, I'm gonna have the pleasure of introducing our speaker, Mary Jabber. As you can see from her bio up on the slide, she has a pretty accomplished background, but I'll call out a few things. She currently serves as the Client Relationship Management Associate at BNY Wealth, partnering with accomplished institutions to build and manage and sustain their wealth. She joined BNY Wealth in 2017 and brings more than 8 years of experience in the financial services industry. Before BNY, she was an outreach specialist for the Harvard Business School's executive education, where she was serving clients and prospects across Central and South America, as well as Asia, Africa, and the Middle East. She holds a bachelor's and a master's of science in political science and international relations with a focus on the Middle East from Suffolk University. And she's committed to leveraging BNY Wealth's 240-year, that's a long history, legacy to help clients achieve their most important financial goals. We invite everybody to please use their Zoom reactions to give Mary a warm welcome. So please give her some virtual applause, some hearts, some thumbs up. And Mary, I'll turn it over to you.
Great. Thank you so much, Sam, for the nice introduction, and good morning to you all. Before we begin, a friendly reminder, if there is a designated plan giving officer or director or VP of advancement in your city or campus, please work directly with your point of contact as you are working through your discussions with donors and prospects. Throughout the presentation, I will be pulling in data from our 2025 Charitable Gift Report. This report encompasses all 2024 gift activity across more than 100 organizations BNY is partnered with, Cal State being one of the organizations, in the hopes of providing current key insights of plan giving trends. So drawing your attention to the presentation, the objectives we will be discussing here is defining plan gifts, understanding the source of plan gifts in terms of funding and donors' intent, and identifying basic plan gifts. Next slide, Sam. So what is plan giving? A plan gift is any major gift made during life or death as part of a donor's overall financial and philanthropic planning. So there are 3 types of plan gifts. We have gifts payable at death, gifts that offer income, gifts that may reduce tax liability, all to the benefit of to Cal State. And the one that you're probably most familiar with are bequests. And while bequests are easy to complete and still the most common type of plan gift and account for the largest piece of plan giving, donors are making larger, more intentional gifts. Gifts that offer income are an important component of plan giving that isn't talked about enough. And I have been asked to present on the gifts that do offer income or the life income vehicles, their differences, and when they should be used, and using the non-cash assets to fund those life income vehicles that will offset and reduce the donor's tax liability while leaving a greater impact for Cal State. And all of this in the hopes that when you are having conversations with your donors, you are comfortable with recognizing the right life income vehicle and speaking to their mechanics. The gifts that offer income and what will be the focus throughout the presentation are the charitable gift annuity and the charitable remainder trust. We will also focus on funding CGAs and CRTs using the non-cash assets, specifically the stocks and bond and the IRA charitable rollover. And the reason the focus will be on these specific funding methods are for two reasons. Outside of cash, they are the most common ways to fund CGAs and CRTs, and they are easily supported by Cal State. For the other types of non-cash funding, like the life insurance and real estate, to fund the life income vehicles, because they are by design more complex and you may not have the resource in-house, be sure to look for outside vendors to work with, or reach out to Wendy and she can connect us as BNY might be able to provide the resources to secure finalizing those life income gifts with these types of funding assets. This is also a timely presentation because there is data that show organizations that are taking in more non-cash funded gifts are growing at a much greater pace than those organizations that are taking in cash funded gifts. And according to the AFP Fundraising Effectiveness Project, the sophistication of gifts is increasing, and there is a need for more professionals to advise on asset mix. And I am here to relay how this can be done with life income vehicles. So who becomes a plan giving donor? Sam, next slide, please. They are individuals who want to leave a legacy or honor a loved one, individuals who are charity-centric and philanthropic, individuals who are wealth builders and building a broader financial plan. As individuals clarify their motivations and select their recipients, they tend to become more deliberate about about the method they use to give. As you are talking to your donors, you really want to listen to how they speak to their experiences while at Cal State and how they may want others to have the experience, all while listening to their financial goals and/or situations. Why should an organization support a plan giving program? Once the decision is made to support a plan giving program, and Cal State has done this, you have to be in it for the long haul and put the work in to build the program. There is always risk, but the benefits exceed the potential risks. Gifts that are unrestricted or have general purposes are great for growing your endowment. And anyone can become a plan giving donor, so you can target and solicit plan gifts to a broad audience, all while securing Cal State's future security. So there are some cues you want to be listening for. Next slide, Sam. As you're having your conversation with potential donors. So when you're asking questions like, do you support other organizations similar to ours? What is important to you about those causes? What are you hoping to achieve with your philanthropy and/or planned gift? You want to listen to these following cues in their answers: that they have a desire to make a larger, more impactful gift. They have a concern over lack of a diversification and/or concerns about providing for their heirs or having no close heirs. Asking the question, any special plans for the future? And they respond with, they are retirement planning. Questions like, have you discussed your philanthropy goals with your professional advisors? Would you be interested in learning more about the tax benefits of funding your philanthropy plan with the gift of assets? Do you want the gift to be a part of your estate plan? Any significant or soon-to-be tax event that could be offset by a charitable deduction? And they may answer with, they have illiquid assets like real estate, equipment, or businesses that they are going to sell. They have a desire to reduce tax liability, and/or their current assets are not producing income. Here's an example that occurred as a result of the charity picking up on some of these cues. The charity was having a conversation with the husband and wife and picked out that they had a concentrated low basis stock and a family lumber business. The donor was concerned about securing income for his wife, but not so much for his children because they had their own source of wealth. He did have an affinity with his church and already had his required minimum distributions going to the church. And now he wanted to make an impactful gift to the charity, set an income for his wife, and mitigate his tax liability. The conversation resulted in a $3 million CRT. If the potential donor is referencing these cues or providing these cues when probed with some of the questions I just went over, this is a good indication a planned gift might be the solution they are looking for. And now that you have a sense of their philanthropic intent, you want to get a good understanding of their financial goals. Are they looking for a fixed stream of income or just consistent payments year over year? Are they securing income for themselves and or their spouse, or are they securing payments to extended family is also a consideration? Are they in the process of selling a piece of real estate or will be coming to a lump sum of cash? This background information will allow you to proceed to going into the different types of planned gift options. So what are those planned gift options? Next slide, Sam. The first and most common or popular gift that offers income is the CGA. One more slide, Sam. Thank you. By definition, a CGA would be a contract between a donor and Cal State where the donor receives a stream of fixed payments in exchange for an irrevocable, meaning the gift cannot be done upfront gift with the remainder going to Cal State at the donor's death. So the overall process is the donor providing the asset to fund the annuity, the donor receives the payments, and at the end of the donor's term, Cal State receives the balance. And CGAs can be set up in three ways. You have single life, meaning the donor is also the beneficiary, two lives in succession. First payment is to Benny 1, and then at Benny 1's death, payments are made to Benny 2 for their life. And lastly, joint and survivor. This is common for married couples filing jointly. Payments are made to both spouses simultaneously, and after the death of the first spouse, the survivor receives the full payment amount. So let's look at the different types of CGAs. Next slide. Yep, thank you. Standard deferred and flex deferred. So standard is the most common type of CGA. Payments are immediate. Deferred CGAs are payments that have set to be dispersed at least 1 year after the gift is made, and the first payment and payout rate is set during the time the gift is made. And flex deferred gives the beneficiary the option to select from a schedule of start dates. The respective payout rates are established at the time of gift. The flex deferred types work for donors who don't need the income right away, but are planning ahead and finding ways to supplement their income for when they do retire. They will also qualify for a current income tax deduction now during their high income years. What we have seen with these types of donors who make these types of CGAs is they will ladder the start payments to coincide with their retirement. Flex deferred CGAs are also underutilized gift annuities, but they are always most beneficial to the charity because they lead to higher residuum, always over 100%, because you have principal that is growing while no payments are being made for an X amount of years. So I'm pulling right from the 2025 Charitable Gift Report. In 2024, deferred CGAs had a remainder value of 235%, while standard CGAs had a remainder value of 85%. As of today, Cal State has 6 flex deferred gifts. The most recent was executed in 2019, and 23 deferred gift annuities, with the most recent being executed in 2024. You all have been successful in setting up these underutilized gift annuities in the past, and you should continue to include these types of gift annuities in your conversations with your donors because they are very beneficial to Cal State. So what are some of the advantages of a CGA? Next slide, Sam. Thank you. They are the most popular form of life income vehicles because they are easy to establish for you and the donor. Lawyers don't need to be involved with a simple 1 or 2 page contract that you can produce using your gifting software, along with gift illustrations that calculates the charitable deduction for the gift and payment taxation for the life of the gift, even before the contract is fully executed. And they provide a fixed rate, a guaranteed fixed stream of income for the donor. For organizations in 2024, we saw new gift annuity activity at its highest in the past decade. We saw organizations execute 677 new CGAs, totaling just under $70 million. 90% of new gifts were more than $50,000. And on the return, gifts that terminated last year held on to 92% of their original gift value, freeing about $42 million to organizations. So now if we look at Cal State's gift activity in 2024, you all brought in 10 new gifts, totaling just above $1.14 million, and all gifts except for two were over $50,000, and there was that one deferred gift. There were 5 gift annuities that terminated, bringing in $232,000 to Cal State, and those gifts held on to 98% of their original gift value. So your gifts are doing great. So what are some of the considerations to a charitable gift annuity? Next slide, Sam. Thank you. There cannot be more than 2 beneficiaries per contract. The income is taxable to the annuitant. The life of the annuity is an obligation to Cal State, and state registration and annual compliance with state insurance departments do differ from state to state and can be time-consuming and expensive. For additional information on the states Cal State is registered in or currently in the process of registering, please reach out to Wendy. Now that we have a solid understanding of what a CGA is, next slide, Sam. And before we apply what we just discussed to a real-life scenario by comparing 2 gift illustrations, a single donor versus a couple, just want to make a couple of points here. The payout rates in the gift illustrations are set by the American Council on Gift Annuities, hereinafter ACGA, a 501(c)(3) organization well organized by charities, donors, state insurance departments, and the IRS. The ACGA is industry standard. The ACGA suggests these payout rates to ensure there is at least a 50% residuum on terminated CGAs. All illustrations used in this presentation will follow this best practice, just as Cal State currently does. Another calculation, the charitable deduction provided in the gift illustrations, is not the full gift value. It is computed by taking the original gift value and deducting the investment in contract. Now, the investment in contract is computed by taking the full annuity amount and multiplying it with the adjusted value of $1 by age, and this is dictated by the IRS. BNY is partnered with PG Calc, the same software you use to run the gift illustrations. So looking at the illustrations, for simplicity, both donors or all donors are 78 years old, and they're funding with $50,000 in cash. And as we just discussed, the most looked to figures are the payout rate and charitable deduction, and you can see the difference here. But I also want to point out that the donor might want to be mindful of the number of years it takes for their payments to be taxed as ordinary income. There is a difference. This will help determine their tax liability in the future in the early stages of setting up their CGA. This is another advantage to funding a CGA. So let's review the tax considerations a little further when discussing CGAs. Next, thank you, Sam. When a CGA is funded with appreciated stock, as long as the donor is also the beneficiary, the capital gains tax will be spread over a term of years. While this reduces the amount of tax-free income, it minimizes the tax liability on the appreciated gain. So the next slide, we're going to see where we will compare and illustrate the tax breakdown of payments between a security-funded and a cash-funded CGA. Next slide, Sam. So again, both donors are 78 years old. We have the single donor funding with $50,000 in cash, and on the other end, $50,000 with securities. And during both donors' life expectancy, part of each payment will be taxed as ordinary income. Part will be treated as the tax-free return of the donor's principal, and the annuity that is funded with appreciated stock, there is a portion for the capital gain tax. So this is the 4-tier accounting system here. And after the life expectancy is met, payments are taxed as ordinary income. The tax-free portion shouldn't be the deciding factor. Remember, we are keeping in mind that charitable giving is a singular opportunity to utilize non-cash assets as an alternative to cash to achieve their philanthropic objectives while reducing their tax liability, all while supporting a charitable organization. So let's take, for example, a situation when a CGA did solve a donor's problem. A BNY client was a healthcare institution. Oh, so you can stay on that page, Sam. Sorry. Thank you. Was working with a husband and wife who were both first-time donors and young in age. They had a personal connection to the institution because of the life-threatening treatment their daughter received, and their car business was bought, and so they had a lump sum of cash. These donors wanted to make an impactful gift to the institution, so we know what their philanthropic intent, and we also know that they had a taxing issue to deal with. So by figuring out the charitable deduction amount they would need to offset their tax liability, they executed a 2-life, $1 million deferred CGA, a win-win for the donors and the charity. So let's wrap up the CGAs with looking at what a typical CGA donor looked like in 2024. Thanks, Sam. So I'm pulling this right out of our charitable gift report. Last year, the median age was 78 years old, and they're typically a repeat donor residing in the states of California, Florida, Tennessee, or New York. They tend to give at the end of the year, and they tend to give to organizations outside of their state and typically to educational institutions. And the median gift was $50,000 in cash. And the payout rate, again tied to the ACGA rate, was 7.6%, and that's up prior from the year 2023. And so once a donor is likely to give again, just as this the donor profile shows, it's a repeat donor. 55% of new gift activity is from repeat donors. So on average, repeat CGA donors we have seen have 6 open gift annuities within an organization. So when you're stewarding and cultivating your relationships with existing donors, it is key. 36 out of 129 Cal State plan giving donors are repeat donors. Another type of gift that offers income is the charitable gift. Thank you. Yep, one more, Sam, thank you. Is the charitable remainder trust. And by definition, the CRT is an irrevocable trust that allows the donor and or beneficiary to receive annual payments for a term or life with the remainder interest passing to Cal State. So the process to execute a trust is first to draft an annuity trust for a CRT, and a CRT is a fixed dollar amount distributed annually, or a unitrust, also known as a CRT, which is a fixed percentage of trust assets distributed annually. And the charitable organization is named the remainder beneficiary. So for the purpose of this presentation, we will focus on the CRT because it is not as likely to exhaust before the donor's life as the CRT would. So just like the CGA, the donor is going to provide the asset to fund the trust, and trusts are typically funded with highly appreciated assets because they're usually tied to a big life or taxable event. The donor receives income for the term of the trust, and Cal State would receive the balance at the end of term. So what are some of these advantages to creating a CRT? The donor is removing assets while preserving the full value of the asset and avoiding the capital gains tax at the time of sale from a taxable estate, all while leaving a legacy behind for a charitable organization. The trust provides a stream of cash flow for the donor, and unlike the CGA, you can have multiple and or successor beneficiaries named. And organizations are benefiting from terminated CRTs. In 2024, terminated CRTs held onto 113% of their original gift value, bringing in just about $65 million to organizations. So what are some of the considerations for a charitable remainder unit trust? The trust's assets are valued annually, so while payments may vary, this ensures that there will be a balance left for the charity, which is ultimately the donor's philanthropic intent. There is more work in setting up a trust for both the donor and charity, and there are higher administrative costs. Trust documents are long and complex, so lawyers and tax advisors may be involved. You need to apply to the IRS for an EIN. You need to obtain the source of wealth to determine legitimate funding of the trust. You need to allow time for the trust account to be open to accept the funding. And lastly, but probably most important, the obligation is not on the charity. It takes risk off the charity because a trust is a standalone entity, and so the organization is not responsible for the payments. So let's review some of the tax considerations for a CRT. The donor will receive an income tax deduction to both the initial funding and any additional contribution. CRTs are tax exempt, but the income generated in the trust is taxable to the beneficiary. So let's take an example of how a CRT worked to solve a donor's problem. One of our clients had a donor who wanted to support the institution and had a lot of stock and wanted to avoid the huge capital gain tax. The donor worked with the charity by looking at their portfolio and funded the trust with their current long-term securities, determined the short-term securities, and when they would hit long-term status, and when they did, the donor used those securities to fund the additional contributions to the trust. With the CRT, the donor was able to ultimately fund a life income vehicle to the desired amount without funding it all at once, mitigating tax liability over a number of years by making additions to the CRUT, and use securities to benefit themselves and the charity. And I really want to emphasize this point here. The donor wasn't timing the market or how well the market and or shares were doing. The donor was focused on the timing of when the securities became long-term to ensure the reduction of their tax liability by spreading the capital gains tax over time. So let's wrap up the CRTs with looking at what did a typical CRT donor look like in 2024? And again, I'm pulling this right out of our charitable gift report. The median age was 79 years old, and the contract executed named multi-donor and multi-life. They gave to educational institutions, but the average gift was $241,000, so much greater than a CGA. And the funding is with securities, which is the opposite of the CGAs. That's typical with cash. And the average payout rate is lower than the CGA payout rate. Here it's 5.72%. And this is actually something that BNY recommends. We recommend that the rates don't be higher than 6%. And the reason for this is growth, right? Investment returns must exceed the rate of the payment in order to maintain donor expectation of consistent payments year over year and to still leave something behind for the charity. All right, so that was, next slide, Sam. That was a lot of information between the CGs and CRTs, and this slide is just gonna allow us to take it all in one slide and do some advantages and considerations for both life income vehicle. So for the CGAs, some of the advantages here that we went over is that it's a guaranteed fixed stream of payments. The income is tax charitable deduction for the donor, and it is easy to establish, takes little time, and it's inexpensive. And you can typically fund a CGA with smaller amounts. Now, some of the considerations for a CGA is that you cannot have no more than 2 beneficiaries per agreement. The annuity is an obligation to the charity, Cal State in this situation. And the charity may need to be registered in the donor state before accepting the gift. Now, some of the advantages for the CRUT. If the donor wants the ability to add to the trust over time, if the donor wants to have more than 2 beneficiaries, if the donor wants to benefit multiple charities at the same time, they also would receive an income tax charitable deduction. And the CRUT can be set up during the donor's life or after death through their will. Some of the considerations for a CRUT. The payments will vary from year to year because the assets in the trust do have to be valued. The income is taxable, and there are setup and administrative costs to creating a CRT. So now that you have the tools to determine a plan giving donor, and if so, the right life income vehicle, let's review the funding sources for a planned gift. Thank you, Sam. While cash is still the most common form of funding for life income vehicles, and whether it be because donors are not aware of the ability to use their non-cash assets or the advantages of using their non-cash assets, or just not knowing that there is no tax benefit to using cash. We know that cash is the smallest piece on anyone's balance sheet and really tightens their day-to-day living when they use their cash to gift. It is up to you all to move away from the ease and speed of using cash and presenting to and educating donors on the benefits of non-cash funding. So all of these non-cash assets here can be used to fund a planned outright gift for the benefit of Cal State. But again, for the purposes of this presentation, we're going to focus on the funding types that are trending and most common for the life income vehicles for either, again, the CGA or CRT, and that is the appreciated securities in the IRA charitable rollover. Next slide, Sam. Thank you. Funding with stocks and bonds are the most common form of non-cash asset, and funding, again, either a CGA or CRT, and it is easy to complete. So first, the donor must coordinate with their custodian who's holding the assets and transfer the funds directly to the charity's account. So in the case here, your plan giving contact will provide you with BNY stock instructions to provide to the donor, where they will then share with their custodian to have their stocks sent to Cal State's account at BNY. This is essential in delaying and spreading.
Sorry about that. Some folks are
No, that's
commenting
okay.
that they lost the slide.
Yep. Okay. So this is essential in delaying and spreading the capital gains tax because BNY will then sell the stocks immediately upon receipt in Cal State's tax exempt account. Again, stocks should not be sold with the proceeds being sent to Cal State. This would be considered a cash gift, and the donor will be taxed on the capital gains at the time of sale. Pulling right out of our charitable gift report, only 24% of new CGAs were funded with non-cash assets, while 94% of new CRTs were funded with non-cash assets. So remember, CRTs are usually tied to a big life or taxable event. So I'm going to end it here with the hottest trend in funding right now for life income vehicles is the IRA charitable rollover. Next slide, Sam. Also known as the qualified charitable distribution. So by definition, a QCD is a one-time tax-free distribution from their IRA to fund a life income vehicle. So the advantages to the QCD is to meet the donor's RMD for that year and minimize their tax liability. So some of the considerations when using the QCDs. QCDs don't qualify for a tax deduction and is only ever taxed as ordinary income. It is a once in a lifetime election. And in 2025, the QCD maximum limit was adjusted to $54,000 to account for inflation. So we do expect if inflation increases that amount will adjust. No additions to the original gift can be made. There cannot be a combination of funding assets, and payments must start right away. So as a result, we are seeing standard CGAs executed as opposed to CRTs because of the dollar limit. QCDs have become a powerful new tool for fundraising and has really changed the game. Historically, funding types were limited to cash and securities, and for the last 2 years, QCDs and non-cash assets were pretty close with the number of CGAs funded. Last year, 21% of CGAs were funded with QCDs, and that's pretty close to the 24% of new CGAs funded with stocks I just said in the previous slide. Out of the 10 new gifts Cal State brought in last year, 3 were stock funded, 4 were QCD, and 3 were cash funded. So you all are bringing a lot of diverse gifts into the Cal State portfolio. And my last point, talk about QCDs as a funding method to new donors because we have seen new donors who fund with QCDs went on to fund additional gifts with other assets and the other way around too. If you have a repeat donor who hasn't made a QCD gift and meet the RMD requirement of 73 years old, talk to them about funding a gift with a QCD. Right, this concludes my presentation. I hope this has given you a better understanding of plan giving, the types of life income vehicles, the funding sources, and the cues you should be listening for that will really help drive your conversations when speaking to your prospective donors. And I hope that hearing about the overall gift activity and the success we are seeing across our organizations, including Cal State, will add to your confidence and provide comfortability when stewarding your relationships with your donors. Thank you, and I'm happy to take any questions.
Thank you so much, Mary. We have a couple in the Q&A, but I see that Vince has his hand up. So Vince, please go ahead. Yeah.
Wasn't
There-
that nice? I raised my hand this time. I usually don't. Mary, question on the QCDs.
Yes,
I do want to ask about that. Um, First of all, the $54,000 limit now, which was raised from 50 to 54, I thought that that was originally designed to go into a CGA. Based on your presentation, that rollover can go into either a CGA or a CRT?
that's
Okay.
correct. Yep.
All right. Now, let's go to a qualified charitable distribution. Just a qualified charitable distribution, the rollover. If I just want to give that to the institution, that's still what, 105 or 110,000?
108,000.
Is it 108 this year?
Yes.
Okay,
Yep. For
great.
inflation. Yep.
What if I want to take that 108 and put that into a CRT?
You cannot.
That's what I thought. Just wanted your
Yep.
confirmation on that.
Yeah.
However, I could do that when I die. I can roll that, I can take a CRT, I mean a QR, I can take any asset in the IRA, and at death, I can bequeath that to a CRT to benefit somebody else, like either my spouse or my children for 20 years limit, I think it is.
I think for the life income vehicle, though, it's going to be capped at the 54,000. So that 108,000 has to be an outright gift to
No,
a charity.
that I totally understand. I'm
Mhm.
talking, that's at lifetime. I'm talking about a death. If I have 500,000 left in my IRA, I should be so lucky. Then I can put, I think, any amount from my IRA account into a CRUT to benefit someone else for 20 years. I think there's a cap on that of 20 years.
That actually makes sense. I'm actually not entirely sure about the death benefit
Yeah. Okay.
on that because it is once in their lifetime.
All right.
So
that's fine.
I'm Vince, I have your email, so I'm actually gonna double check, but I wouldn't be surprised if that's not the case either, but
Okay.
I'm curious. I'm gonna look into that and I will confirm
Well, I
if
thought
that
it
is the
was.
case or not,
Yeah, I
because
thought
I
it was only
also
because
thought the
I thought it was
QCD
only because I
has,
think it was a year or two ago, maybe 2 years ago. I think Congress passed a limit on the stretch IRAs, and we couldn't do this. Yeah.
I
Okay,
think
that's
the
fine.
key, I think the key here though with the life income vehicle, Vince, is it has to be during their lifetime. It can't be done after their lifetime, but I'm going to double check.
It's all right. Thank you, Mary.
You're welcome, Vince.
Thank you, Vince. You got us really into the weeds there for a Plan Giving 101 webinar. But hey, being creative is part of the development game. So thank you for bringing that up, Vince. Mary, one question we got via the Q&A. Folks are wondering what about those 4 states that you mentioned in the profile slide for the CGAs that made the donors in those particular states so common?
We typically see actually, so this was the first year that we saw that. We typically see the West Coast, particularly California, where they tend to get from those states. And this year we saw it more on the East Coast, primarily in the Southeast region. Those donors just tended to give a little bit more. Actually, I can provide, if you guys give me 1 second, because I did have the report up here, just to give you a little bit more of a breakdown. So from, so the Northeast, they gave the highest amount, 30%, or 30%, the donors made up 30%, but their average gift value was actually the lowest, even though they made up the most. If I look at the Southeast, so we're looking at like Florida, Tennessee, those states, they made up 26%, but they're like double in the average gift value amount. So they were bringing in 145,000. And so for the West states, primarily, California, 19% from the West Coast, and the average gift value was 96,000, closer to 97,000. So it's not to, you guys are all bringing in great gift values. It just so happened this year it was in the West Coast, but that's a great observation. We do tend to see it from California or the West Coast. But it also, we do have some large donors, that are in New York, Florida. So it just kind of depends on the year too. But this year was an off one. It's a great question though.
Awesome. So just a bit of a shift in the trend, nothing
That
necessarily
we
tied
saw. We'll
to.
see if it continues to be a trend or if it was just the off year this year, next year when we look at our data.
Awesome. And then folks are wondering if they can get a copy of BNY's charitable report, but I think, Wendy, are you on that one? Making sure folks get
Wendy, I
access.
think you should have, did you get that email from Dave Holer on May 1st that,
I'll share it with the group,
okay, as
forward it
long
to
as
the
you
plan
got
giving
it.
group.
Okay, great. Thank
Awesome.
you.
Thank you, Wendy. And I'll invite folks to continue to share your questions. I do have kind of just a few clarifying ones, given that this is a 101 session. Is there a particular, and this is both kind of at Mary and Wendy, is there a particular age kind of threshold for when donors can get payouts from their CGAs? I think it's like 60, you have to hit a certain age before you can get those payouts, correctly?
So for plan giving vehicles, it's going to vary depending on what it is. For charitable gift annuities, it's 55 currently, but we're looking at changing that a lot higher because we have it pretty low. But yes, it varies. For case reporting standards, it's different. I think we have it at 65. For internal guidelines, it's different. So you would have to reference your internal policies.
Thank you for that one. And then there isn't, or if there is, what's the minimum for creating a CGA with the Cal State pool?
For the CGA, it's currently 10,000.
10,000. Perfect. And then I'll call out for folks on the webinar, as Mary was going through those different illustrations, the gift wrap software that we use through PG Calc does a lot of that work for you. So if some of those percentages were a little overwhelming, don't worry about it. There's a very customized piece of software that helps you kind of map all that stuff out in pretty common English to help explain that to donors as well. Mary, when you called out that there was an obligation to the charity, that's referencing to if, for whatever reason, the CGA, the annuity kind of runs out of money to make those payments, then that the charity has to backfill those, right?
That's correct. So we call those either underwater gifts or the gifts have become negative in value. So there's no longer that gift ate away at its principal. And so the charity or Cal State in this situation will be left with nothing. But due to that annuity that's in place, that agreement that's in place, Cal State is on the hook to make those payments for the life of the donor. And so the pool, because it's a pool, hopefully it's self-sufficient at that point, sustaining itself. The pool will absorb the underwater gifts, and you'll continue to make those payments for that donor's life. You do tend to see this. You'll see it. It's common in a lot of programs, especially now with donors living longer, right? Expectancy is a lot higher. And back then we're seeing this with older gifts too, where some organizations were not strictly adhering to the ACGA rate. But you should be confident that you all are adhering to the ACGA rate, and this is a really trusted way and calculated way to make sure that you're at least holding 50% of the gift value, so that when it does terminate, the likelihood of it going underwater is less. But there are some things that are out of our control, right? Like the market, the timing of things. But if you have a healthy pool and you're bringing in those diversification of the gifts with the donor profiles into the pool, it should sustain itself. And so if you have a couple of underwater gifts, it's okay.
Awesome. Thanks for clarifying that for everybody. Another kind of clarifying question too, when you were talking about funding these gifts with stocks and um, waiting for those things to become long-term. Could you explain a little bit more about what that means? I think that's like a capital gains thing, right?
Yes, yes. So anything under, any securities that are under a year that you've held them are called short-term securities. You want to wait for the securities to at least become a year before you sell them. And so that's why in that instance with that donor, the donor was timing it to at least get and you probably all have noticed that in the PG Calc software when you're doing your illustrations, there's a breakdown between the short term and the long term. So it's beneficial to wait for the securities to become long term, and then using those long term securities to fund either the CGA or the CRT, because it just mitigates the capital gains tax. And so that's what you really want to look at. The donor should really be looking at their portfolio, not so much just focused on what's going on with the market, because the market can change tomorrow, 3 days. And one of our that we follow at BNY here in our investments group is our best thinking is you got to think you're in the long game, right? You're investing long term. As long as you stay invested in the long term, you'll make out okay.
Awesome. Thank you for that perspective. I do have one more kind of general question for you. Maybe you can speak to any common misconceptions that donors or development officers have about the risk or complexities of plan giving.
Yes, great question, Sam. I would say non-cash assets. If the donor does not know that they can give other than with cash, they might not talk about, the nice piece of property they have by the beach, or that they're thinking of selling it, or, something with a business that they're looking to sell. And it's not complex, right? It might take a little longer because we have a custodian that we're dealing with and, filling out whatever necessary paperwork. So it takes a little longer than cash, but there's just so much more of a benefit to the donor to using their securities, and then they're likely to fund another gift, hopefully, because they're able to mitigate their tax liability. So I think that's the biggest misconception, is not, or the complexity of plan giving, is to not talk to our prospects or donors to using the option of using securities or any other non-cash assets to fund a life income vehicle, and leave their cash in their account so they can use that freely. But the illiquid asset, being able to use that to fund a vehicle, is not as complex. It does take a little longer, but it's something that can easily be done too.
And we have a
Awesome.
couple of questions in the Q&A
Yeah, some of them are a little CSU focused. You want to
that
take
I
those,
can
Wendy?
answer. Yeah.
Thank you.
So CRTs are not, I don't know what a CRU is. So CRTs, are the CRTs managed by CRU, by the CSU or by individual Cal State University? So they're managed individually. We don't have a system-wide program for CRTs, only this charitable gift annuities. A couple of other basic questions. Is there a CSU-wide trusted services partners, or are these partnerships made individually by campuses? They're made individually. Every university has different trust services for what their needs are. We partner with BNY Wealth for the charitable gift annuity programs under the CSU Foundation. Specifically, is there a central CSU vendor for PG for plan giving services? No, we share them in our plan giving groups and share what works, what doesn't work, but there's no central services that people use. We do have system-wide contracts for like PG Calc that people can tap into for the rates. Using Crescendo, well, this campus uses as Crescendo and calculation services, and it appears that we offer CGAs. We currently do not actually contract for these as far as I've seen. So we have 21 of the 23 universities that have charitable gift annuity program MOUs with the CSU Foundation. Everybody uses them at different amounts on different levels. Some I haven't seen in the last 10 years. Some I see every quarter or so. The usage of them, it varies, and it depends really on the how people are marketing CGAs at the campuses. We use PG Calc for the illustrations for CGAs, and all of the campuses that partner with us have a license. So check in with me regarding that license. We normally assign it to the plan giving director or an advancement services person that's taking lead on doing the illustrations for that campus. And
Awesome.
Joseph, I can touch base with you offline.
Awesome. Thank you for knocking those out, Wendy. And thank you, Joseph, for bringing forth some really good questions there to clarify. Vince, second round, what are you thinking? Just flagging that you need to go off mute there.
Gotta unmute myself over here. Mary, real quick question, going back to the CGAs funded with appreciated securities long-term. You said something about, I know that it's spread out over, I think, life expectancy on the capital gain. You said something about the donor being one of the beneficiaries. Tell me how that capital gains tax is treated if the donor is not one of the income beneficiaries, please.
It's a great question, Vince. If the donor is not the beneficiary, they don't get, they'll have to pay for the capital gains tax up front.
Up front in the year of the gift.
That's
Okay,
correct.
great to know. I did not know that. I'm glad you did, so thank you.
You're so welcome.
We're all here to share knowledge, Vince. Thanks for asking. Alrighty, Mary, I have one more kind of general question for you.
Yes.
What does, in your opinion, donor stewardship look like after someone establishes a planned gift? Are there best practices for maintaining that engagement?
That's a great question. And we get those questions across all of our clients. And it's a tough one because it really does depend on your donor base and the organization. But I will say, just based off of data that we see just with the reports that we produce, is that once a donor is likely to be a donor again. So just thinking of ways of making sure that you're staying in touch with that donor or their family is really important. And how you do that, I think it just really depends on, how Cal State, how they do it. But I think that's the challenge. But donors like to have that outreach. And so I think as long as it's consistent, you'll get another, and you're building on that relationship, you'll get another CGA or, a CRT if that's what it is.
Awesome, thank you. I know several of our universities have plan giving societies. The names vary a little bit, but it's the folks that have established a plan gift. They're still living, so they get kind of special outreach. And I know a few teams kind of
Yes.
fold kind of the standard stewardship to their plan giving donors as well. So I'll take your head nods as those being good ideas. Awesome. One more question for you, Mary, and this is tapping maybe your international experience. How often do you see international donors or alumni using planned giving, and are there any unique tax or legal considerations there?
It's a great question. We actually don't see them so often because life income vehicles are primarily for US citizens. However, there are some of our clients that we do see international donors, but depending on the country they reside in and their status, whether they're, visa or they're a citizen of their adopted U.S. citizen. It really just depends, and since it varies so much by country, it's dictated by the country, their home country, and since each country it varies, so that goes to the percentage of tax withholding that needs to be with the payments they receive, the legal documents we might need to have on file. It does depend. So again, we don't see it so often because it's meant for natural U.S. citizens. But we'll see it from time to time. But it varies, so it's kind of hard to say too.
That's a good one to pick up the phone and give you a call, right, Mary, to,
Yeah, that's right. Yep.
to walk through
Yep.
that consideration.
Yep.
Awesome. Alrighty, one final question for you, and this is maybe more at our emerging advancement shops. How do you recommend a smaller advancement team screen for potential plan giving prospects with limited donor data? And again, maybe keeping that focused on life income vehicles like CGAs and CRTs.
I think one way to use the database that you have is looking at, their graduating year for your alum and looking at the folks that are close to 73 or at 73, and you can reach them for their QCD where they can get that RMD, and you could get that QCD funded CGA. I think that would be the one way to look at it. Definitely any folks over 70, they tend to give the most, the 70 to 79. However, the age group of 80 to 89, they give the most as far as dollar amount. So I would look at graduating year and look at, how old they are and reaching out for those specific reasons.
Awesome. I'm sure teens will appreciate that one. And with that, as we approach the top of the hour, I want to thank you so much, Mary, for joining us here and giving us all this awesome insight. One logistical question for you. We did get this in the chat. Is it okay if we send along the slide deck to folks?
Oh, yes, that's fine. Yep.
Alrighty, stay tuned, everybody. That's
Yes.
coming your way along with the recording. It'll live on YouTube, so once it's up, you guys will get an email notice, and you can send that along to anybody who might be interested, and come back to it and refresh yourselves on the content as well. With that, thank you all so much for logging on, and stay tuned for future events and learning opportunities from the Advancement Academy. Keep up the good work and bringing in those donors, and we want to just see those numbers grow, and keeping the folks at BNY busy with all the money we're giving them. Have a
Right.
great rest of the day, everybody, and a good week.
Thank you,
Thank you so
Mary.
much.
Thanks,
Thank
Sam.
you. Thank you, Vince.
Bye.
Bye, everyone.